In the book Rich Dad, Poor Dad, Robert Kiyosaki explains that he had two dads, a rich dad and a poor dad. The rich dad was wealthy because he focused on building assets, while the poor dad remained poor because he focused on his salary and getting raises. Robert followed the rich dad's approach, which is why he is wealthy today. He focuses on building assets, not just earning a salary, so he can live comfortably without working. Robert explains the difference between assets and liabilities simply. An asset puts money in your pocket, while a liability takes money out. Today, we'll discuss 8 assets that can put money in your pocket. These are common assets that require some initial investment. Many people want to build assets but don't know which ones to invest in or feel they need money to start. This information is useful for those people. Don't forget to comment, "I'm ready to change my life," if you're committed to your financial journey. Your path to wealth begins now, and I'm here to support you every step of the way. Let's get started. The first asset is shares of a company. Are you wondering why I prioritize buying shares of companies? For those who know about investing, this is a great way to earn money. But for those with less knowledge, buying shares can be risky. So, which shares should we buy? Peter Lynch, a famous investor, says the average person has 2 to 3 good investment opportunities each year that are right under their nose. To take advantage of these, you need to pay attention to what's happening around you. For example, a hairdresser knows which hair products are popular. A doctor knows which new medicines are essential. A housewife can tell which new products are liked by her friends. A model knows which brands are trending. Peter Lynch advises that when you notice these trends, check if the companies making these products are publicly traded. This doesn't mean you should buy their shares right away. First, shortlist these companies and read their financial statements. Look at how much money they make and if they have debt. This helps you find good investment opportunities. Understanding a company's financial health is crucial. You should look at their profit margins, revenue growth, and debt levels. If a company is consistently profitable and has manageable debt, it might be a good investment. Additionally, consider the company's market position and competitive advantages. Are they a leader in their industry? Do they have a unique product or service that sets them apart? Peter Lynch also points out that people often do the opposite. A doctor might invest in a raw material company instead of a pharmaceutical one, while someone working in raw materials might invest in pharmaceuticals. People often think other industries are more profitable and ignore the ones they understand. This is why he says the stock market takes money from the impatient and gives it to the patient. Moreover, patience and long-term thinking are essential in investing. The stock market is volatile, and prices can fluctuate in the short term. However, investing in solid companies with good fundamentals usually pays off in the long run. Avoid getting swayed by market hype and focus on the underlying value of the companies you invest in. It's also wise to diversify your investments. Don't put all your money into one stock or one sector. Spread your investments across different industries and types of assets to reduce risk. This way, if one investment performs poorly, others may do well, balancing your overall portfolio. The key point is that money never sleeps, and there's still time for you to invest in different industries. By being observant, doing your research, and making informed decisions, you can uncover valuable investment opportunities. Remember, the goal is to build wealth steadily and consistently, rather than chasing quick profits. Investing is not about timing the market, but time in the market. The sooner you start, the more time your investments have to grow. So take a proactive approach, educate yourself, and begin your investment journey with confidence. Number 2, licensing. Licensing isn't a common practice among the upper middle class, but it's a valuable asset worth considering. Licensing can be a strong source of income, as shown by Bill Gates, who earns royalties from Microsoft. This kind of passive income means you can keep earning money without doing much ongoing work. For everyday people, Stephen Key is a great example of making a lot of money from simple ideas. He created and sold Michael Jordan's wall ball game, earning commissions from various products. Stephen Key is an inventor and entrepreneur who has licensed more than 20 products, making millions in royalties. One of Stephen's major successes was a design he sold to a company, which paid him every year for 10 years. He only spent about $20 to $30 to create this design. Another of his successful inventions was the twist. a basic bottle with an extra label that reveals more information. This design earned him $1 million a year. The idea behind licensing is to put in time and effort once and then enjoy ongoing returns. Even if you don't own the company or have the customers, if the idea is yours, the rewards can be substantial. Why licensing is valuable? Licensing allows you to leverage your ideas and creativity into a long-term income stream. It works by granting a company the right to use, produce, or sell your invention or product, usually in exchange for royalties or a licensing fee. This can be particularly beneficial because 1. Passive income. Once the licensing deal is set up, you can earn money continuously without further effort. This frees up your time to pursue other ventures or enjoy life. 2. Scalability. Licensing enables your product to reach a larger market through the company's established distribution channels, increasing potential earnings. 3. Low upfront costs. Unlike starting your own business, licensing typically requires less initial investment. You don't need to worry about manufacturing, marketing, or distribution costs. 4. Risk reduction. By licensing your product, you transfer the risks associated with production and sales to the licensee company. This can be a safer way to monetize your ideas. Steps to start licensing your ideas. 1. Develop your idea. Create a prototype or detailed design of your product. Make sure it solves a real problem or fulfills a need in the market. 2. Research and patent. Conduct thorough research to ensure your idea is original. Consider filing for a patent to protect your intellectual property. 3. Create a pitch. Develop a compelling pitch that highlights the benefits of your product and why a company should license it. Include market research and potential earnings. 4. Identify potential licensees. Look for companies that operate in your product's market. Make a list of potential licensees and gather contact information. 5. Negotiate the deal. Reach out to these companies and present your idea. Be prepared to negotiate terms, including royalty rates, payment schedules, and duration of the license. 6. Legal considerations. Hire a lawyer to help draft the licensing agreement and ensure your interests are protected. Examples of successful licensing. Apart from Stephen Key, many others have found success through licensing. For instance, Spanx. Sarah Blakely invented footless pantyhose and licensed the idea, leading to a billion-dollar business. The Snuggie. This popular blanket with sleeves was licensed to various companies, resulting in widespread sales and significant profits. Licensing is a powerful strategy that can turn simple ideas into lucrative income streams. By focusing on creating valuable products and finding the right partners, you can achieve financial success without the complexities of running a full-scale business. Number 3, index funds. American index funds, such as those tracking the S&P 500 or Dow Jones Industrial Average, act like large collections of stocks that mimic the performance of entire market indices. Instead of buying individual stocks, investors pool their money into these funds, which then distribute investments across hundreds of companies. For instance, the S&P 500 Index Fund doesn't focus on just one company. It spreads investments across the 500 largest corporations in the U.S. This diversification helps reduce risk because if one company's stock goes down, it might be balanced out by another company's stock going up. These funds are popular among wealthy individuals for long-term investment strategies aimed at steadily growing their wealth. Even during market downturns, these investors often see opportunities to buy more shares at lower prices, potentially increasing their returns over time. However, there's a socio-economic aspect to consider. When middle-class investors withdraw their money from these funds during market downturns, wealthier investors who remain invested can benefit from this redistribution of funds. Over time, this trend can contribute to a wealth gap, where the rich continue to accumulate wealth from these investments, while others may miss out on potential gains. In summary, index funds offer a straightforward way to invest in the stock market with low fees and reduced risk through diversification. Yet, their impact on wealth distribution underscores broader economic trends and disparities. Thanks for watching so far. We appreciate your support and hope you're finding this content valuable. If you're enjoying the video, please take a moment to subscribe and hit the like button. Your feedback helps us know we're making a difference and motivates us to keep creating more great content for you. Okay, let's continue now. Number 4, real estate. According to Forbes, real estate is a great way to become rich. Wealthy people often invest their money in property in a few different ways. One way is flipping houses. This means buying a house for less money than it's worth, fixing it up, and selling it for a higher price later. You can make money by renovating the house or just by holding on to it as its value goes up over time. For example, in California, someone might buy a house with trash and a broken sewer line for a low price. After cleaning up the property and fixing the sewer, they could sell it for 3 or 4 times what they paid in a few years. Some investors prefer to keep their properties long-term instead of selling them right away. This lets them build wealth over time as the property becomes more valuable. There are 4 main benefits to owning property. 1. Long-term income. Real estate investment can provide a reliable source of long-term income through rental payments. Investors can generate steady cash flow from rental properties, which may increase over time as rental rates rise with inflation or property improvements. Many investors use rental income to cover property expenses, mortgage payments, and generate additional profit. Leveraging rental income allows investors to pay down mortgage debt and build equity in the property while potentially receiving positive cash flow. This income stream can be particularly advantageous for retirees or individuals seeking passive income to supplement their earnings. 2. Property appreciation. Real estate tends to appreciate, meaning its value generally increases over the long term. By holding onto property, investors benefit from this appreciation, which contributes to their overall net worth. This increase in value can be influenced by factors such as location, economic development in the area, and improvements made to the property itself. Unlike some other investments that can be volatile, real estate historically tends to appreciate steadily, making it a relatively stable asset for wealth accumulation. 3. Tax advantages. Owning property offers several tax benefits that can significantly reduce the amount of taxes an investor owes. For instance, property owners can deduct expenses related to their rental properties, such as mortgage interest, property taxes, maintenance costs, and depreciation. Depreciation is a non-cash expense that allows property owners to deduct a portion of the property's cost over its useful life, as determined by the tax code. This deduction reduces taxable income, thereby lowering the amount of taxes owed. Additionally, certain tax incentives may apply to encourage investment in real estate, such as deductions for energy-efficient upgrades or credits for historic property renovations. 4. Using other people's money. One of the biggest advantages of real estate investment is leveraging OPM, borrowed money, to purchase properties. This allows investors to control larger assets with a smaller initial investment of their own money. Banks and financial institutions are often more willing to lend money for real estate investments because property serves as collateral. Compared to either investments like stocks or businesses, real estate financing is typically easier to obtain. This leverage can accelerate wealth accumulation as the property appreciates in value over time. Number 5. Digital assets. Digital assets encompass a wide range of investments that exist purely in digital form. Cryptocurrency, such as Bitcoin and Ethereum, are well-known examples. These digital currencies operate independently of traditional banking systems and can be bought, sold, and traded online. Blockchain technology, which underpins many cryptocurrencies, is also a digital asset. It's a decentralized ledger system that records transactions securely and transparently across multiple computers. Additionally, real estate investment trusts, REITs, are another form of digital asset. These are companies that own, operate, or finance income-producing real estate. By investing in REITs, individuals can gain exposure to real estate markets without owning physical property themselves. The appeal of digital assets lies in their potential for substantial returns and their accessibility. Unlike traditional investments that may require significant capital or extensive infrastructure, digital assets can often be bought and sold with relative ease using online platforms. This accessibility allows investors to diversify their portfolios beyond stocks and bonds, potentially increasing overall returns while managing risk. For younger generations especially, digital assets offer opportunities for entrepreneurship and income generation. Creating digital products like online courses, ebooks, or software applications allows individuals to leverage their skills and knowledge repeatedly without the limitations of physical production or distribution. This scalability means that once a digital product is created, it can be sold to countless customers worldwide with minimal additional effort. Jack Ma's reference to Walmart illustrates a shift in business dynamics. In the past, expanding sales often required opening more physical stores, which was costly and time-consuming. Today, digital scalability allows businesses to reach global markets instantly through online platforms and digital marketing strategies. This efficiency not only reduces overhead costs, but also accelerates revenue growth and market penetration. Number 6, bonds. When a company or government needs to raise money, they can issue bonds as a way to borrow from investors. Think of bonds as formal agreements where the issuer promises to repay the borrowed money, the principal, along with periodic interest payments over a specified time period. This promise of repayment makes bonds a relatively secure investment compared to stocks, where returns are less certain and depend on the company's performance. Government bonds are particularly favored by many investors because they are backed by the government's ability to tax and can be considered very safe investments. They typically offer higher interest rates than traditional bank savings accounts, making them attractive to those looking for more substantial returns on their investment while still prioritizing security. This combination of security and potential for higher earnings makes bonds, especially government bonds, a preferred choice for many cautious investors. Number 7, businesses. Businesses can be lucrative investments, especially for wealthy individuals who view them as assets that generate income without requiring active day-to-day involvement. While some high-profile figures like Oprah Winfrey and Elon Musk are passionate about their work and not solely motivated by money, the landscape of business ownership has evolved. Today, there are dedicated websites where you can purchase existing online businesses. These platforms cater to individuals interested in acquiring a business that is already established and generating revenue. This approach appeals to entrepreneurs who recognize the value of skipping the initial stages of building a business from scratch. The appeal of buying an online business lies in its potential for immediate profitability. If you already possess a strong social media presence or marketing skills, acquiring an established business allows you to leverage your existing audience. By making strategic adjustments or introducing new products, you can capitalize on your audience's interests in purchasing behavior, thereby accelerating your returns and saving considerable time and effort compared to starting a business from the ground up. Number 8, network. One of Dhirubhai Ambani's team members recounted a story about how, in his early days with limited funds, Ambani would visit upscale hotels and enjoy tea there. When asked why he did this despite having little money, Ambani explained that he wanted to observe and learn from the lifestyle of wealthy individuals. Moreover, he saw these visits as opportunities to network with influential people. Ambani believed strongly in the power of networking. He understood that building relationships with successful and well-connected individuals could open doors to new opportunities and valuable insights. By immersing himself in environments frequented by the affluent, Ambani not only gained inspiration, but also strategically positioned himself to forge alliances that would later play a crucial role in his entrepreneurial journey. This approach highlights Ambani's entrepreneurial mindset, where every encounter, no matter how small, was seen as a potential opportunity for growth and advancement. His ability to leverage networking as a tool for personal and professional development ultimately contributed significantly to his success in building one of India's largest conglomerates. I've shared 8 proven ways to build wealth and achieve financial security. Wealthy people use these methods. They work hard once and reap rewards for life. Many millionaires prefer investing in real estate because it's easier to get loans and offers tax benefits. If you don't want to start a business, investing in successful companies' stocks can also build wealth. It's crucial to have the right knowledge for smart investing. Licensing is another way to make money with minimal investment. Stephen Key, for example, earned millions in royalties with a small initial investment. If you want to understand this topic in detail, you can read or listen to his audiobook, Turn Your Dreams into a Licensing Goldmine, while allowing others to do the work. For more informative content on finance, entrepreneurship, and self-improvement, subscribe to our Voice of Wealth channel. We post new videos every other day to help you succeed in various aspects of life. Have a great day and see you in the next one.